In the design and construction industry, one of the biggest issues to address in joint venture arrangements is who is going to control the accounting function. I'm thinking specifically about joint ventures between design firms to execute a project or between construction companies to execute a project. In most joint venture arrangements, there's going to be one party that is the larger and more dominant one, and the risk to the smaller party is that the larger and more dominant joint venture will control the accounting function and do so in a way that unfairly shifts the financial burden of the project to the smaller joint venture. In many cases, the joint venture is going to take its gross income, it's going to pay its expenses, and then it's going to distribute profits to the joint ventures in their respective shares of the venture. And the larger party could, at least in theory, dilute the profitability of the joint venture by unfairly assessing costs to the joint venture that should be borne by that larger party alone. Ultimately, that's a fancy way of the larger party taking money out of the smaller party's pocket. And in a perfect world, the joint venture would have a clear set of rules for which expenses would be borne by the joint venture. There'd be complete transparency on how accounting was performed and some sort of real-time role for the smaller party in accounting, other than as just a passive observer, in addition to some form of appeal to dispute resolution like litigation or arbitration if the smaller party thought that the accounting was run unfairly. Unfortunately, in many cases, the larger of the two joint ventures gives itself all ability to control the accounting function, and it leaves the smaller party with very little rights. So, what would a joint venture agreement look like that tried to deal with some of these issues on behalf of the smaller party? One thing that the smaller party might wish to consider including in the joint venture agreement is something with language along the lines of, the parties can only charge the joint venture those expenses which are directly and solely related to the performance of the joint venture agreement, necessarily incurred by one of the parties for the proper performance of the agreement, or similar. Similarly, the joint venture agreement could identify in an index of costs, perhaps, those which would be chargeable to the joint venture. And that might, for example, include the effort and the labor of both parties that they're putting in directly pursuing the work of the joint venture, but exclude things like the wages and salaries of each party's employees and benefits like sick leave and bonuses or profit sharing, or costs are incurred that are incurred by one party rather than the joint venture for its own business functions rather than for the function of the joint venture. And that's obviously not a comprehensive list, but joint venture agreements should sometimes contain an index of what kinds of costs would be chargeable to the joint venture and which kinds of costs would be controlled and charged to each individual member of the joint venture. Typically, the larger of the two joint ventures also controls the major accounting functions, and the joint venture agreement might say something along the lines of the accounting records would be available to the other party. But that doesn't provide the smaller party with much of a role. And so historically, when I've looked at good joint venture agreements, I've seen some sort of an affirmative financial reporting requirement that's imposed upon the larger party. The contract might say something like, once a month, and perhaps before meetings of the executive committee of the joint venture, the joint venture's treasurer, which is typically going to be an employee of the larger party, is going to furnish to the parties at the expense of the joint venture a balance sheet and a statement of income and expenses of the joint venture, and current monthly statements from the joint venture's bank accounts, and anything that may be reasonably requested by the both joint venture parties. I also like to see in joint venture agreements some form of end of project accounting. This is particularly important for the smaller of the two joint ventures because they wouldn't want to find out at the end of the project that profits or losses were taken in such a way over the course of the project that it was too late and they had no recourse. And so, an example of a final accounting provision might, say something like, after the joint venture receives all of the payments that it's going to receive from the owner. It's going to determine each party's participation in the joint venture, the receipts and the disbursements and the profits and the losses of the joint venture, and allocate a specific dollar amount of profits and losses that are going to be shared by the parties. Now on a perfect project, the two joint ventures would be happy and they would waive the final accounting. That's what happens if everything goes well. But I have seen some joint venture agreements where both parties can insist on that final accounting. And disputes about project accounting would then be resolved by formal dispute resolution processes like litigation or arbitration, neither party having the unilateral ability to break disputes where there's a one-to-one tie over accounting functions.